I get calls all the time and people say, hey, I want to start a pest control company. What's the best area to get into, right? Like I can go anywhere in the country. Where should I go? You know, where are the acquirers interested? What, you know? And I always say that this market has been, you know, I started in pest in 2003 and it was extremely static. It was a duopoly. It was Orkin and Terminix buying these things. The market was pretty sluggish. And then over time, as the acquirers have changed, as the market has gotten more sophisticated, you ended up with pockets of a tremendous amount of activity. And what I mean by that is, if you think about 2016, anticimex came into the United States. It's a Swedish firm. And just like Europeans, they came across and they started on the East Coast, right? And they started in New Jersey as opposed to Boston. And they bought a bunch of companies up and down the East Coast. And so now I had rentokil, I had terminix, orkin, and now I've got a new acquirer called anticimex spending a ton of money buying Modern and JP McHale and Killingsworth and all these companies up and down the East Coast and then doing a bunch of add-on acquisitions. And the Mid-Atlantic got super hot. And I could sell a business in the Mid-Atlantic, so basically Virginia, DC, that area, I could sell that. If I took the exact same company in Phoenix, Arizona, and plopped it down in Virginia, it would sell for a 30 or 40% premium. And the reason why is the scarcity of assets, and you've got a lot of acquirers competing. In this market now, I think it's important for folks to look at the fact that we've got financial sponsors or private equity firms that have entered the market, and they're not building national businesses. They're building regional businesses. And so we've got the Southeast, we've got a handful of them there, we've got the Mid-Atlantic, Pacific Northwest. So we have these guys entering markets and focusing on particular geographies. And, you know, when I think about like auction theory, you know, to run a really good auction in a perfect world, you need 6 to 8 participants. You add one additional acquirer to that mix, though, and it can dramatically change the market clearing price, or, you know, the price of the business on the margin. So that's a lot of words to say, do I think it's attractive? I do, because the first thing I look at for a market is the growth rate, right? Is this market growing, or is it a net exporter of people? Like, do I want to be in Phoenix or Syracuse, New York? Well, people are leaving Syracuse and they're moving here. So population growth is, of course, the #1 driver. It's the biggest tailwind that you can have for a resi service business, people moving into a market. So I would say that checks that box. The other thing is people say, well, Paul, like, you know, the Southeast is super hot. There's a lot of private equity firms doing a lot of stuff there, so that's the market I should be in. And I say, no, that's the opposite of that, because that activity is taking place now. You're not selling your business right now. It's great to be there right now if you would have done that 20 years ago, but you didn't. So don't go there now. Find those areas of high growth that are going to be hot in the future. And there really hasn't been, the Southwest has not seen nearly the same activity that we've seen up and down the East Coast. But that's coming. And so I do think for folks like you out here who are thinking about the future, focusing on your cash flow, because private equity firms are cash flow buyers, right? They don't care about your revenue mix as much. They don't care about your absolute amount of revenue. They're focused on your cash flow. So it gives you, and, you know, when I talk about cash flow, people say, well, shit, how am I supposed to grow a business at 12% a year and then also have 25% margins, because I got to invest back in the business? And you're right, there is an interplay between your growth rate. You know, you can take a company that grows at 20% a year with 5% margins because they're investing everything back in the business, and then you got another guy who's doing a 30% margin. Well, he's growing at 2% a year. He's actually going backward, but he's kicking off more cash today. Which one would you rather buy? The one growing at like 2% a year, that's a has-been. I want to buy the guy that's growing cash flow into the future, because all valuation is forward-looking. So there is some interplay. It does take a little bit of, you know, what the big public companies do is they sit back every year and they say, okay, how much are we going to reallocate into this business? How much are we going to reinvest? What do we want to target our margins to be? Are we a growth stock, or are we a dividend stock? Where do we want to be? That's a corporate strategy, business strategy type decision that you have to make.